Began our discussion today by referring to audit risk. Now, that's a concept that's been around for a long time. However, for the past few years, auditors have also had the requirement of performing risk assessments, haven't they?
The risk assessment standards, which came out in 2006, were designed to force the auditor in planning to identify the risk of errors or fraud that are most likely within a client. As opposed to what many did in the past was a balance sheet audit where they focused basically on the material balance sheet accounts. What has happened with the risk assessment audit approach is that we now have to take a look at the risk of error or fraud in both end of period balances, which is traditionally the balance sheet approach, and during the period activity, which is typically income statement, revenue, and expense accounts. By expanding the audit approach to incorporate during the period risk for, again, principally revenues and expenses, it's caused the auditor to become more aware of issues that may be taking place at a client and is more likely to cause the auditor to identify those issues that may in fact be incorrect or inappropriate or just may appear to be unusual. So the risk assessment audit approach, which again is basically an enhanced planning approach that leads to tailored audit procedures to minimize the risk of error or fraud, is a very, very significant and changed approach to what many auditors did prior to 2006. Recently, Becky, there has been a revised audit guide that the AICPA has issued to try to capture the scope and the intent of these audit standards in a manner that they can be more efficiently utilized. The audit guide that the AICPA has issued deals with assessing the risk of material misstatement in conducting a financial statement audit. That audit guide, as I said a moment ago, should be very helpful to help auditors better understand the scope of the risk assessment audit approach.